And in business, the Bank of England has raised interest rates again as it seeks to tackle soaring inflation.
It's the most aggressive monetary tightening since 1981.
It's really worrying, it's scary, and it's scary because there's no reassurance.
At the beginning of the summer, I asked the question, are we there yet? With equity and fixed income markets having corrected significantly, the question was, were valuations cheap enough? And my answer back then was, no, not yet. Well, what has changed?
We will focus on growth, even where that means taking difficult decisions.
Tax cut, after tax cut, after tax cut.
Amazing today how many MPs I came across who were looking at their phones and looking at graph lines, and they were the graph lines that showed you the pound sliding against the dollar, the graph lines that showed you the cost of government borrowing going up.
Look at where that line has gone up to now. So that's now up to 6.07%.
The government has today decided to make further changes to the mini budget. Firstly, we will reverse almost all the tax measures announced in the growth plan 3 weeks ago.
According to the Fed, this interest rate hike won't be the last. They expect interest rates to hit 4.6% in the next year.
President Putin says the sanctions imposed on Russia represent the biggest current threat to the world economy.
In many ways, the news has remained challenging. Central bankers have made it clear that they're willing to sacrifice growth in order to quell inflation. And at the same time, geopolitical tensions remain high and energy supplies remain tight. So where do we go from here? It's important to remember that although it feels like we're living through unprecedented times, we have had bear markets driven by rising rates before, and we do have the frameworks to consider the risks.
Big moves in those yields there, leading to a broad-based sell-off here in the equity space.
The 30-year fixed rate mortgage, 7.6%.
Although the news remains challenging, valuations are improving. The improvement in valuations is most obvious in fixed income. So let's talk about yield. If we take US investment grade debt, which is the higher quality corporate debt in the US, we've seen yields more than double this year. And high yield debt is finally living up to its name. This yield is important because it provides a cushion in people's portfolios and also means that as we head into 2023, there are scenarios where bonds could deliver very attractive return. We're still cautious on equities because we think that risks of recession are very high and therefore we need to see capitulation on corporate earnings expectations. What would make us more bullish? Well, if we saw evidence of softening wage growth or lower commodity prices, that would be very important because it would allow the central banks to back off and to not have to raise rates quite so aggressively. So those are the things that we're watching very closely as the year ends. Ultimately, in a rate-driven bear market, which is what we're living through at the moment, we need to see the battle against inflation being won. For now, patience is still a virtue.